There's a man sitting in his car outside his apartment. It's late at night. The parking lot is quiet. The lights from the buildings are slowly turning off, but he's still sitting there, hands on the steering wheel, just thinking. His phone lights up again. Another notification. Credit card payment due. Student loan payment due. Rent due. Car insurance due. He opens his banking app, looks at his balance, and then closes it immediately. He doesn't want to see it, because he already knows the truth. He works hard. He works 40 hours a week, sometimes more. He's not lazy. He's not irresponsible. He's doing everything he was told to do. Go to school, get a job, work hard, earn money, and everything will be fine. But everything is not fine. Every month feels the same. Money comes in, money goes out. Nothing stays, nothing grows. And slowly, he starts realizing something nobody ever told him. Working for money is not enough. If you want to build wealth, you need to learn how to invest. This is the moment many people experience in their life. Not when they are broke, not when they have no job, but when they are working and still not moving forward financially. Because the biggest financial trap is not unemployment. The biggest financial trap is working your whole life and still being broke at the end. And this is exactly why investing is important. Investing is how normal people build wealth, not by winning the lottery, not by becoming famous, not by starting a billion-dollar company, but by investing small amounts of money for a long time. So in this video, I'm going to explain how to invest for beginners step by step in the simplest way possible. This is not trading. This is not gambling. This is not get rich quick. This is real investing. The kind of investing that people use to build real wealth, retirement income, passive income, and financial freedom over time. The first thing you need to understand is the difference between income and wealth. Income is the money you earn. Wealth is the money you keep and grow. Many people have high income but no wealth. They earn $5,000 a month, $10,000 a month, even $20,000 a month, but they spend almost all of it. So even though they earn a lot, they are not wealthy. Wealth is not about how much money you earn. Wealth is about how much money you keep and invest. This is the first mindset shift you need to make if you want to become financially successful. Now, before you start investing, there are a few steps you must follow. Most beginners skip these steps and then they struggle later. So step number 1 is building an emergency fund. This is very important. Before you invest a single dollar, you should have at least 3 to 6 months of living expenses saved in cash or in a savings account. This money is not for investing. This money is for emergencies. If you lose your job, if you have medical bills, if your car breaks down, if something unexpected happens, this money protects you. Without an emergency fund, you might be forced to sell your investments when the market is down. And that is how people lose money in the stock market. Not because investing is bad, but because they were forced to sell at the wrong time. Step number 2 is paying off high interest debt. If you have credit card debt with very high interest, paying that off is one of the best investments you can make. For example, if your credit card interest rate is 20% and your investment return is 8%, you are losing money. So before investing in stocks or index funds, pay off high interest debt first. Always remember this order. Emergency fund first, high interest debt second, investing third. Now we come to the actual investing part. This is where most beginners get confused. They think they need to pick the best stocks. They think they need to watch the market every day. They think they need to learn technical analysis, charts, indicators, and all that complicated stuff. But the truth is, most professional investors cannot beat the market consistently. So if professionals struggle to beat the market, beginners should not try to be stock picking experts. The smartest thing beginners can do is invest in index funds. Index funds are one of the best investments for beginners and long-term investors. An index fund is a fund that invests in many companies at the same time. Instead of investing in one company, you invest in hundreds of companies. This reduces risk and makes investing much safer. One of the most popular strategies is investing in a broad market index fund. When you invest in a broad market index fund, you are basically investing in the entire economy. Some companies will go up, some will go down, but overall the economy grows over time, and your investment grows with it. Now let's talk about how much money you should invest. Many people think they need thousands of dollars to start investing, but that is not true. You can start investing with small amounts like $50, $100, or $200 per month. The most important thing in investing is not the amount, it is consistency. Investing is not about investing a lot of money one time. Investing is about investing money regularly for many years. Even small amounts can grow into large amounts because of compound interest. Compound interest is the most powerful concept in investing. Compound interest means your money earns money, and then that money earns more money, and then that money earns even more money. Over time, your money starts growing faster and faster. In the beginning, the growth is very slow. It almost feels like nothing is happening, but after many years, the growth becomes very large. This is why starting early is more important than investing a large amount later. Time is more important than money in investing. Let's say someone invests $200 every month. That is $2,400 per year. This may not sound like a lot of money, but if that money grows over many years, it can turn into a very large amount. This is how retirement accounts grow. This is how passive income is built. This is how financial freedom is built. Slowly, over time, not overnight. Another very important concept in investing is consistency. There is a strategy called dollar cost averaging. This simply means you invest the same amount of money every month, no matter what the market is doing. If the market is high, you invest. If the market is low, you invest. If the market crashes, you invest. This strategy reduces risk and removes emotions from investing, because the biggest enemy in investing is not the market. The biggest enemy in investing is your emotions. People get excited when the market goes up and they buy at high prices. People get scared when the market goes down and they sell at low prices. This is exactly the opposite of what successful investors do. Successful investors stay calm. They invest regularly. They think long term. Long term is the most important word in investing. Investing is not for 1 year. Investing is not for 2 years. Investing is for 10 years, 20 years, even 30 years. The longer you stay invested, the more money you make. Time in the market is more important than timing the market. If you want a simple step-by-step investing plan, it would look like this. First, save an emergency fund. Second, pay off high-interest debt. Third, open an investment account. Fourth, invest in index funds or ETFs. Fifth, invest every single month. Sixth, increase your investments when your income increases. Seventh, hold your investments for many years and do not panic when the market goes down. If someone follows these steps for 10 to 20 years, they will most likely become wealthier than most people around them. Not because they are smarter, not because they are lucky, but because they were consistent and patient. Wealth is built slowly. Wealth is built quietly. Wealth is built when nobody is watching. And one day, after many years, the results become very visible. Most people try to look rich. Few people try to become rich. Looking rich is buying expensive things. Becoming rich is buying assets. Assets are things that make you money or grow in value over time. Stocks are assets. Index funds are assets. Real estate is an asset. Businesses are assets. The more assets you own, the more money you make. It is that simple. Most people work for money their entire life. Rich people buy assets, so that assets make money for them. That is the difference. If you want financial freedom, you need to reach a point where your investments generate income. That income is called passive income. Passive income means money you earn without working every day. This is the goal of investing, not just to grow money, but to build passive income over time. And I want you to remember one very important line. Poor people spend their money and invest what is left. Rich people invest their money and spend what is left. This one habit can change your entire financial life if you follow it for many years. So don't wait for the perfect time to invest. Don't wait until you earn more money. Don't wait until you understand everything. Start small. Start simple. But start now, because the earlier you start investing, the easier your life will be in the future. And the longer you wait, the harder it becomes. Investing is not about getting rich fast. Investing is about getting rich slowly, but almost certainly, if you don't quit. And one day, years from now, you don't want to be that man sitting in his car at night, stressed about bills and money and the future. You want to be the person who is calm, financially secure, and free. And that future does not depend on how much money you earn. It depends on what you do with the money you earn starting today. This video is for educational and informational purposes only and should not be considered financial advice. Investing involves risk and you can lose money. Always do your own research before making any investment decisions.